Okay, what's going on, everyone? This is going to be the first video for chapter 4. We're looking at the income statement, comprehensive income, and the statement of cash flows. At a very high level, right? Our income statement is looking at our profit, namely our net income, for a period of time, right? Generically, very high level, right? It's going to be your revenues minus your expenses, get you your net income. We will build upon that, right? You add or subtract to that different other comprehensive income items to get to your comprehensive income. Ultimately, what happens is, right, this net income goes into retained earnings. And this OCI, right, goes into an account called AOCI, right, our accumulated other comprehensive income. And I like to think of them like two different piggy bank accounts, right? This is like piggy bank one, this is like piggy bank two, where we kind of collect and store our earnings in there. What's the difference, right, between the net income and OCI? The idea with this is OCI is going to have a broader kind of concept. In other words, we will look at some items that wouldn't necessarily be a revenue expense, a gain or loss up there, that we would still need to account for, right? It's almost like a different rule set we follow, right? So like this first piggy bank, right? Imagine we're putting just like only our pennies, our nickels, our quarters in there. Whereas our second piggy bank down here, it's a different type of analysis, right? It might be like, hey, our Bitcoin in there, right? It wouldn't go in the original piggy bank, but we would still analyze. It's a broader view. Okay, so that's the idea with the income statement, comprehensive income. We'll look at that. We're also going to examine the statement of cash flows, right? It's going to be your beginning cash plus or minus, namely your inflows or outflows from your operating, investing, or financing activities, get you your ending cash. With regard to the operating section, there's two ways we can prepare it. They get you to the same end result, namely the direct method and the indirect method. So we'll talk about that in the second video. Starting with the income statement, right? At a very high level, one of the things we're going to be doing in this chapter is distinguishing income from continuing operations and discontinued operations. So just keep that big picture in your head as we go through this lecture. And also be aware that on the income statement, we do have to disclose our earnings per share, right? Your basic earnings per share and your diluted. We'll talk about what those mean. When we are discussing income from continuing operations, the first thing you're really going to look at is the operating income, right? That's the top part of it. And we're going to be looking at our revenues, specifically when we earn those revenues, we'll credit them, and our expenses when we incur them, right? Revenues are going to be pretty much the fundamental reason we're a business, right? If we're Apple, this would be from like selling our iPhones, right? Our expenses as well, right, are going to be essentially those outflows that help support the revenues, right? Our operating expenses in this area. And when we talk about expenses, right, a lot of it comes down to matching, right? We're trying to match our revenues with the expenses. It can be cause and effect, right? That can be like one type of matching. So if we sell our goods, right, then we'll do cost of goods sold, right? It's like a causal relationship. If then, right, we have our revenue from the sales, we try to match it with our expenses. Another one would be kind of systematic and rational, right? We buy a building, right? There's our building that we do all our operations in. We don't expense that immediately, right? Instead, we capitalize it, we put it on the balance sheet. Over the next 10 years, right, as that building helps us generate revenue over that period, we will take the associated expense, right, to try to match it, namely depreciation expense. Okay, so kind of the starting point with our operating income at the top. Fundamental reason we're a business are the revenues, the expenses are trying to match to that. We also have kind of secondary items on there, kind of other income, right, or non operating items, right? So these are increases or decreases in equity from transactions not classified as revenues and expenses and not involving owners. What might be an example here? Gain or losses when we sell our equipment, right? If we have Apple, right, and they have some type of machine that is making iPhones, and they happen to sell this thing at a gain, right? That gain wouldn't necessarily be a revenue, right? It's not the fundamental reason we're a business, not from selling iPhones. Instead, right, it would be a gain in kind of the other area, our non operating area. So a difference between a revenue, the fundamental reason we're a business, and a gain, kind of a secondary transaction. Same framework for expenses and losses. Okay. When we look at our income from continuing operations, that kind of macro view, if you zoomed in, right, you will have kind of your operating items, right, the fundamental reason we're a business, how we run on a day-to-day basis. We will have our non-operating items, tend to be those gains and losses, associated with the business we talked about. I like to think of this kind of our operating as active, right? It's what we're doing. We're selling iPhones. We're doing this. Whereas non-operating tends to be, it's not always, but it tends to be more passive, right? If we, for example, had some interest income or interest expense on there, we were kind of sitting around the interest accrued. We weren't affirmatively selling our iPhones out there. You'll also look and kind of stop for your income taxes on there. We'll look at that. But overall, right, when we prepare an income statement, right, there are two ways we can do it: a single step versus a multiple step or multi-step. Both get us to the same bottom line, right? 150 is 150. With the single step, right, it's exactly that, one step. Revenues minus expenses get you your net income. That's about it. It does get a little nuanced, right, because they have a little stop sign down there. But you can think of it just like one step. We list out all our revenues, we list out all our expenses, and we figure out the difference between them. Multi-step income statement and distinction is very more specific, right? We're going to have a lot of like stop signs, as it were, intermediate or subtotals that we want to focus on, right? So we're looking here, right, kind of at our, for example, some of our operating and non-operating activities. If we look at the top, right, sales minus cost of goods sold, that would give you your gross profit, right? That would be the first stop sign. Why we do these intermediary totals is we might want to focus on one thing, right? So for example, as a way of an analogy, right, if we were looking or analyzing at football teams, right, the first thing you might say is like, how good is your quarterback, right? Because that's going to determine everything else. Here, kind of similar thing for gross profit, right? We're looking at the really fundamental, what do you sell it for and what does it cost you to make on there? If we expanded on that analysis, right, then we would say, okay, well, now we're going to look at maybe your offense and your defense as a whole, right, as the football team. In the same way, when we look at the income statement there, we will break it out and start looking more at the other parts of your operating expenses, right? Your selling, general, administrative, so on and so forth. So that's kind of like generically what you think of the team, the offense and defense, the fundamental reason for playing football. Here, the operating section at the top is going to be generically your operating income and operating expenses. Outside of that, right, once we get our operating income, then we can look at those kind of non-operating items or that other section. This would be like examining kind of like our special teams, right? When you think of football, like, yeah, I guess you think of the kicker and whatnot, but it's not really the first thing that comes to your head, right? So kind of same thing down here. We would have the intermediary kind of subtotals in there for that. Okay, so that's what this is talking about, right? Gross profit is that kind of first stop sign, fundamental. It's like looking at the quarterback, just looking at your product. What do you sell it for and what does it cost you to make, or what do you pay for it? We go a little bit further and then look at your operating expenses, the other items on there, to land at your operating income. So it's kind of stop sign 2. Then we look at those non-operating items, the other income, the other expenses, and we get to our pre-tax book income, right? Our income before taxes. We back out tax expense, and that would get us to our net income. This illustration right here, we would not have any discontinued operations. So, if you don't have that, you would just land at net income. Otherwise, this, if you did have discontinued operations, we'd have to stop at continuing operations, then do discontinued, then we would get to net income. Okay, so you can look at that MCQ. One of the things with, when we're looking at the income statement, we have to look at more than just the numbers, right? We have to distinguish temporary earnings from permanent earnings in an earnings quality framework, right? So, like, say I was trying to evaluate whether, you made a lot of money each year, if you had a good job, and you said to me, well, hey, last year I made $1 million, right? But you failed to tell me that, oh, by the way, last year I won $990,000 in the lottery, right? So that would probably be a temporary event, right? I mean, I guess you could be really lucky and win year over year, but I'm not sure that I could then say safely, oh, well, this person makes a lot of money each year. That would be like a 1 year blip from it. Similar thing for businesses, right? Were your earnings for this year from like a one-time event, right? Maybe there was like a specific tax law that really helped you, or hey, maybe it was COVID and a lot of people had the stimulus money, or were they more permanent, right? Are we going to expect these year over year over year? And in this framework, right, when we as accountants kind of present the income statement, there are a little bit of ways where we can play with the numbers, right? The first is income smoothing, right? When we do GAAP and financial statements, there are times, right, where we're going to have assumptions and estimates, right? So we're going to have to exercise professional judgment. What you would do, obviously, you'd have to be ethical about it and within the confines of GAAP, but instead of looking like, oh, we're up, we're down, we're up, we're down, we basically adjust these assumptions and estimates each year such that we kind of smooth out the income over time, right? So, for example, we might overestimate expenses in the current year to reduce net income and then reverse those estimates in future years to increase net income. Okay. Another thing that's could happen that you have to be careful with is classification shifting, right? So what happens here is, oh, we have these kind of operating expenses, right? Our investor is focusing, right here on our operating income. We want to make that look bigger, so we're going to shift one of those expenses down here to maybe an other, item, an other expense. That would be reclassifying in such a way to emphasize or make one of the stop signs or subtotals above look or appear more favorable. So you have to be kind of careful with that. Okay, you can look at that MCQ pretty straightforward. One thing with temporary earnings, right? You would see them, and it is possible to see them in the operating section on there. And there are some type of unusual items that we may see on there. So, for example, goodwill impairment, impairment expense on maybe long-term fixed assets, and then restructuring costs or expenses. So, let's talk a little bit about these, right? So, restructuring costs. These include costs associated with management's plan to materially change the scope of business operations. They're recognized in the period the exit or disposal cost obligation actually is incurred, right? What does this mean, right? So restructuring costs are like we're changing our strategy on there. We're restructuring our operations. Maybe, for example, we're a fully in-person business, brick and mortar. Now we want to go online, right? 100% online to sell our goods. We have to close down our plant or our kind of sales stores, and we have our employees there, right? And oh, by the way, when we do this, sorry, employees, we have to let you go. But we're going to be nice, right? We're going to give them kind of a payout on there, the employees. And if, for example, those termination benefits, they have to work for them, like, hey, we're closing down the building in a month from now. For the next 4 weeks, if you work, we will give you this payout. We would accrue that expense, namely a restructuring cost, as it's incurred. If, however, no work is required, okay, we're closing down the plant tomorrow, right? You don't have to work or anything for this, but we're going to give everybody $10,000 on there. At that point in time, we would take the restructuring cost when we told the employees. Similar kind of framework for costs associated with closing facilities. So that's one kind of unusual item when we're looking at earnings quality. Another would be impairment of long-lived assets. We'll talk about that in later chapters. Overall, right, so when we're looking at earnings quality, you are going to want to think about things like major customers, misstatement of revenue, premature revenue recognition, right? So for example, major customers, hey, if we're really reliant, like if 90% of our stuff we sell to one client, if that client goes down, we're out of business, right? So we need to keep these things in mind when we evaluate that overall kind of earnings quality there. So that was looking at, kind of that operating area, right? Our operating income. So we'd look at the fundamental reason we're a business, the associated expenses on there, and that would get us to our operating income. Afterwards, right, you would move down. We're still in income from continuing operations, but you would look at your non-operating income. So this would be like your other income, your other expenses, right? So this would be interest income, interest expense, gain or losses on the sale of investments. Likewise, that like kind of machinery, equipment. So we talked a little bit about these items. They can be income on there. They could be losses, right? So it can either increase or decrease. So this would be like Apple, for example, selling their machine. Tends to be more passive in income and losses on there. It tends to be more secondary or peripheral to the fundamental reason we're a business, right? So hey, we landed at the operating income, the other kind of fundamental reason we're business. Now we're in this kind of other section, tends to be more passive on there: interest income, interest expense, equity income, other income or loss. Sometimes there are, when we release income statements, we'll kind of set and put out a second set called our non-GAAP earnings. This is a little bit controversial because what we do is we kind of pluck out certain revenues and expenses that we potentially don't like in the GAAP-based earnings to show a different picture, right? So maybe some of those unusual events, right? Like restructuring costs would be like, oh, well, we don't want to put that in there because that's like sort of unusual, right? Acquisition costs, write down of impaired assets, right? We would exclude certain revenues or expenses and then make a second set on there to show our investors, lenders, and creditors. These are controversial, right? Part of the reason is you can pick and choose whatever you want on there. So you do have to look at those carefully. Here's a restructuring cost. You can look at that, right? We're generally going to do when it's incurred. So that was our continuing operations, right? We had that kind of giant area there, right? We had our operating income, right? We had our non-operating income, kind of active, passive, fundamental reason we're a business, secondary, peripheral transactions. All of that was our income from continuing ops, right? So give me a break there. I'm trying to write with a mouse, okay? Now, right, once we established that income from continuing operations, the next thing we have to consider are discontinued operations, right? That's kind of the next section. Discontinued operations are reported when a component of an entity or group of components has been sold, disposed of, or considered held for sale. Like, hey, we're trying to sell this thing. It represents a strategic shift that has or will have a major effect on the company's operations and financial results. We will report this separately, right, after continuing operations. So what might be an example of a discontinued operation, right? So say we have Apple, right? They have their kind of iPhone division. They have their Beats division, right? Like the headphones. And then they had their iPod division, right? Once upon a time, there were iPods, right? Nobody wants an iPod anymore. So they're like, hey, we're going to get rid of this division, right? We're holding it for sale and we're trying to sell it in the current year. Or maybe we did sell it in the current year. That's what we're going to look at in this kind of subpart of the chapter for how do we account for that. So it's a discontinued operation. Typically, it'll be like a product line. It could be a geographic area, right? Like we're getting rid of our West Coast operations, our European operations on there, okay? So we'll report it after, right? There's our income from continuing operations, everything we just talked about. Then afterwards, we will put either the income or loss from that discontinued operation. We have two kind of things that can happen here, right? So the first one is when it has been sold, right? So here we are during the year, right? We look at it, we said, okay, we have our iPod division, right? At a certain point, we're like, okay, let's put this for sale, right? It's available for sale. And then we sell it right before the end of the year, right? So we sell it at the end of the year or before the end of the year, right? Because let's just say that's 12/31. What we have to do in that discontinued operations section, right? We have to look at our basically income or loss, right, from the iPod division, right? How much did we make or lose from that during the time we for the year on there, and then what we then have to do is essentially look at, right, so this is, income or loss from the operations from the beginning of the reporting period to the disposal date. So we're going to look at that whole kind of shooting match until we sold it. And then we also have to look at the gain or loss on the sale, right? When we sold it, did we make money? Did we lose money? This will make more sense with numbers. Okay, so let's look at an example here. Right, we have a company who is holding a division for sale, right? So there's one division that they're trying to sell it. It looks like on December 18th, right, we sold it, so that's good. So we sold it. In October, right up there, we decided to hold it for sale. Okay. What we first have to look at, is our income or loss from the beginning of the period to when we sold it, right? So that's going to be, in this case, $5 million, right? It will be a $5 million loss on there. Typically, it will be a loss, right? Because you wouldn't really want to get rid of an operation or a service line if it's profitable. So most of the time, it could be a loss. It could also be a gain, right? Maybe we just have this division that's profitable, but somebody comes along, or we get some offer we can't refuse on there. But in any event, from the operations from the iPod division, from the beginning of the year to when we sold it, it lost $5 million. At the sale, right? If we look at the sale, right, we must have had a gain on there of $3 million, right? We sold it for 15, and our carrying value was 12, right? So that's good. That's great. We had a gain of 3. What we then do, right, is we net these, right? That will take it to overall a -2 pre-tax loss. And then what we do is, okay, well, that loss, that $2 million loss, we can get a tax benefit from it. In other words, we can use that loss to help offset our future income on there. So that will create a benefit to the extent of the marginal tax rate, 25%, right? 0.5 tax benefit, right? Now that's because it's a loss, right? A loss produces a tax benefit. If, for example, we were profitable overall from this, there would be, an additional kind of tax obligation to that. So it's not always a tax benefit down here. But in any event, when we net these, right, the -2 and the 5 on there, we are going to be looking at 1.5 overall loss for discontinued operations, right? So we have our continued operations, we do our discontinued operations. This is net of tax, right? Because we consider the tax obligations. That here with a tax benefit, it could be additional tax liability. We then take our continuing and we net it with our discontinued. Overall, our net income will be 18.5. This is the scenario where we hold it for sale and we sell it in the same period. Compare that with, right, we hold it for sale, right? At some point during the year, it's available for sale. Here we are at the end of the year, we have not sold it, right? So it's still for sale, right? What we have to do here is figure out our income or loss from operations, essentially, again, for the whole period on there, from the beginning of the period to the end of the reporting period. And then at the end of the period, see if there's any kind of impairment loss on that item, right? So let's look at a second example here, right? We have a company, right? It looks like in October, they decided to sell one of their divisions, right? So here we are in October, we're saying, hey, this division, our iPod division, is available for sale. As of the end of the year, it's still for sale, right? So what we have to do here is first figure out for the entire reporting period on there, right? Did we have income or loss from this division? In this case, right, it looks like there was a loss of 5, right? So we lost 5 on that. And then at the end of the period, right, we have to evaluate if there's any impairment, right? It looks like here, right, our book value for the iPod division is 12. The fair value in this case is 9, right? So to the extent the book value exceeds the fair value, we are going to have an impairment loss of 3, okay? That's what this guy is saying. All right, so we have -5 from the operations. We have -3 from the impairment at the end of the year. This is the situation where we hold it for sale, but we haven't sold it. We then will net those two, right? -8. We'll look at, again, because it's a loss, it creates a tax benefit. In this case, again, a function of the marginal tax rate, a $2 million benefit. Overall, right, we're going to be at a -6 loss from discontinued operations, right? So we have our continued netted against our discontinued gets us our net income, okay? Here's some MCQs. You can read and look at those. Right, so let's continue here. Right, now we're going to talk a little bit about accounting changes. Right, we really have 2 major ones that are up here and then a third one down there. Right, so we have a change in accounting principle, estimate, don't worry about reporting entity, and then we need to know how to deal with errors on there. So let's change at the slide there and start with the first one, namely a change in accounting principle. Right, what might be an example of this? Right, we go from FIFO for our inventory to LIFO, right? That's a principle we were using to account for our inventory. We now have changed that. How do we deal with this, right? Well, the overall approach is going to be retrospective. Most of the time you're doing retrospective. I like to think of it like Back to the Future 2, right? And Back to the Future 2, they go back in time. So for example, right, say we were using FIFO in year 1, FIFO in year 2, FIFO in year 3. Now we're in year 4, right, and we use LIFO. What do we do here? Right, we have to go back, right, and essentially update, like restate those prior financial statements as if we used LIFO. And then what we can do is, right, essentially then use those and then, use LIFO here in year 4, right? So that's one way we can do it. We can restate prior period financial statements as if we use LIFO. Another is, right, instead of restating those, we can look at the cumulative effect, i.e., if we had used LIFO, like hypothetically the last 3 years, how would it have affected our net income and retained earnings? And then essentially as of the beginning of year 4, right, we would make some type of adjustment to beginning of year retained earnings to reflect that amount, right? So change in accounting principle, like Back to the Future 2, we go back in time on there, okay? The next one here, right? Change in accounting estimate, right? I like to think of this like Back to the Future 1 because we are just going from now into the future, right? This is accounted for. The magic word is going to be prospectively. So what are some examples for this, right? There's certain times we make estimates, right? So like bad debt expense, right? That allowance for uncollectible accounts. We estimate how much we're not going to collect. Maybe warranty expense, right? We sell stuff and we think X amount of people are going to take us up on that warranty, but we change those estimates. How do you deal with this, right? So maybe we're going along, we have an estimate for allowance for doubtful accounts, i.e. bad debt expense in year 1, 2, and 3. And then in year 4, we change that amount, right? We change the estimate. Well, what we do is just prospectively from here on, right, Back to the Future 1, moving into the future now and into the future, we just use an update in light of that change. We do not have to go back and restate those prior financial statements, okay? One thing to be aware of is change in depreciation, amortization, or depletion method, right? This is considered to be a change in accounting estimate, and we will account for it prospectively, like we just talked about. Okay? How about errors, right? Maybe we screw something up on there. If it happened, right, in the current year, right, and we catch the error, you basically just undo it, right? You fix it in the current year on there. But say we had the current year and then last year, right, and the error happened last year, what essentially in that case you need to do, right, is you need to fix it in last year, potentially restate that last year if we have it available or presenting it. And then we can make a prior period adjustment, right? So that's kind of the magic word for errors, prior period adjustment. We basically just update our beginning of year retained earnings and then those balance sheet accounts in light of correcting the error, right? So that's kind of what this is saying. If there's a material error, we're going to have to update our balance sheet accounts and the income effects, right? Our retained earnings for that, and then restate any previous financial statements on there. Okay. Talk a little bit about earnings per share. You would see this at the bottom of the income statement, and it's exactly that, right? It's your earnings per share, right? So we have basic earnings per share, right? Your net income minus your preferred stock dividends over your weighted average number of common shares on there, right? So it's the average of your number of common shares. So what that means is because it's the weighted average, you have to look at how much you had at the beginning and any kind of new shares that were issued on there. Okay. We also have the diluted earnings per share. And essentially what this does is, right, it takes, right, we have our numerator and our denominator, which essentially looks at our number of shares, right, our common shares. Here, what we're doing is we're saying if hypothetically everybody who could have common shares, i.e., for example, convertible stock, if they converted on there, what would then be the earnings per share? So what we do here is we potentially increase the denominator, which decreases the amount. So the upshot of that is basic earnings per share when we compare it to diluted. Diluted is always going to be equal to or less than. You can look at that example there. We're going to stop there, right? Because that's kind of the end of the income statement, and we will pick it up here with comprehensive income.